Good afternoon. Good afternoon. It's the 8th of December. Welcome to another edition of Monday Market Picks. My name is Silan Vikramasinghe, the head of research for Maybank Securities here in Singapore. Now, we've come to that part of the year where we start reflecting and thinking about what the year has been so far. And I think it's a good time to take a pause and have a look at how the markets have performed this year. What were some of the key factors that move markets? And most importantly, what are the lessons that we can carry into 2026 and who will be the winners in 2026? So that's what we're going to focus today. Today, the format of the show is going to be a bit of a special one. I will have telco and internet analyst Hussein Isaifi, healthcare and transport analyst Eric Ong, and REIT analyst Mia Liu joining me to look back at 2025 and also discuss what they have seen in the different sectors. And I'll also cover the financials as well. Then we'll move over to Thailand, where we will have a look at Airports of Thailand, which is a SDR stock, and why we've upgraded the target price there. And then we'll go over to Indonesia and have a look at bukalapak.com, which we have downgraded to a hold. Plus, we've got some fresh trading ideas from our chart guy as well. So a lot to go through in today's show. So let's start with Singapore. Now, when we think about 2025 and so far this year, the STI is up about 20%. One of the best performing markets globally, outperformed the S&P as well. And volumes have surged this year by around 50% so far. Now, it's a good time to look back as a team and reflect on some of the key trends that have actually driven this momentum, and also look at some of the stocks that will be impacted and some of the stock winners as well. Now, one thing I want to kind of talk about and highlight is that 2025 has been defined by extreme volatility. And I think Singapore really offered something that is very rare, which is a premium on certainty. And part of that came from AI deployment, especially in areas like the banks, financials, healthcare, with efficiencies really transitioning into real impact. Then we also saw policy delivery being another anchor. We saw meaningful follow through in areas like equity market reform, transportation reform, fiscal support, infrastructure build out. And these policies really gave our analysts the confidence to upgrade their earnings across multiple sectors. We also saw a rational competition emerging, particularly in areas like the internet and telcos, that actually increased margin certainty as well. So to discuss all this, I've got Eric, Husseini, and Mia joining us. Welcome guys to the show. Maybe Eric, I will start with you and healthcare. Now, an interesting part of your write-up in our reflections report. And by the way, audience, if you haven't downloaded this report, it's available on our newsletter today. Very, very interesting report. You should definitely keep this as your holiday reading. Now, in this report, you highlight that healthcare is the second largest budget item in 2025 after defense. Now, Eric, what's actually driving this? And how do you think that's going to evolve going forward?
Hi, Dylan. Indeed, the Singapore government has allocated almost 21 billion for healthcare this year, mainly used to enhance public healthcare facilities, including new hospital, community care centers, while also providing subsidies to keep healthcare affordable for local patients. Going forward, Health Minister Ong Ye Kung has also indicated that healthcare spending is expected to rise significantly, potentially reaching 30 billion by 2030 due to the increasing needs of the aging population. We understand that a lot of these monies are going towards building more facilities such as new hospitals, nursing home, as well as footing manpower costs. And for your information, based on MOH data, we saw that the average length of stay in public hospital has also gone up from 6 days in 2019 to 7 days in 2022. So this represents a 15% increase in patient load. With longer waiting times, we think that this may have some positive spillover effect to private hospital operators like Raffles Medical.
Right. Now, you've actually been talking about how AI and automation can come in and, drive earnings and margins in this sector. So what are some of the policy responses and what are you actually thinking about? What have you seen and what are you thinking about in terms of how these technologies are going to help?
Yes, so the Ministry of Health has recently launched the Healthcare Industry Transformation Map 2025, which emphasizes on innovative and sustainable strategies to improve population health. And this aims to build a future-ready workforce and enhance the research and ecosystem within the healthcare system. The healthcare sector is also focusing more on digitalization and technological advancement. This includes the integration of AI and robotics in healthcare delivery and will aims to improve patient outcomes. We think that this will help to enhance its operational efficiency through optimizing resource utilization, streamlining care delivery processes, and moreover, the growing emphasis on personalized medicine also allows for tailored treatment based on individual genetic profiles. This could enable private healthcare players like Raffles and Thomson to offer more specialized and higher value-added services to improve their pricing and margins going forward.
Got it. Now, just to add to Eric, I mean, when I look at the banking sector as well, I think this AI thematic is probably in Singapore is probably one of the earliest places to play the AI use case thematic. I think globally, a lot of valuations and a lot of flows have been going into AI capacity build out. Especially by the Magnificent Five. But I think now, as we progress in this cycle, more and more investors will be looking at how is AI being used, not the capacity, but how is AI being used to drive optimization, drive earnings, and drive new businesses. And I think the banking sector in Singapore is one of the leaders here. Very interesting when I look at overall operational efficiencies and productivity by employees. In 2025 so far, productivity, if you measure it by operating profits per employee for the Singapore banks, it's actually gone up by about 5% year on year. That's actually happened during a time where we've had very steep declines in interest rates, and also the workforce in the Singapore banking sector has actually shrunk by 1%. Despite that, operational efficiencies are going up. So I think part of that is driven by the technology investments and AI investments. So I think this is going to be a trend that is going to get broadened, not just in the financial sector, but across multiple other sectors. And as Eric said, the healthcare sector is also already seeing that. So I think this is something that we will be watching out for much more closely going into 2026 as well. Maybe at this point, let me also talk about, apart from AI, we also talked about the policy reform pace that is taking place. And I think the policies is also kind of helping in terms of consolidations and competition being a lot more pragmatic going into 2026. So maybe I'll bring Husseini here. Now, 2025 was a year we finally saw some telco consolidation in Singapore, but it was not the way we expected. I mean, everyone was expecting StarHub to buy over M1, but what we ended up was with Simba buying M1. So what are your thoughts on this as you look back at industry consolidation and positioning in the telcos?
Yeah, sure. Thanks, Thilan, for having me. Yes, so the consolidation in Singapore was due for quite some time. Singapore is a small market with 5 to 7 million population, but it had 4 mobile operators and several MVNOs. So it was super intense. Prices, the mobile plans were up for almost $7, $8, 300 GB kind of data. And the ARPU, if we see for the last 5 years, has come down by almost 35 to 40%. Okay, so the competition was super intense, and 2025 was also not an exception, wherein we had seen mid to high single digit kind of revenue decline. Now, as I said, that the consolidation was due for quite some time, and it is finally happening with Simba taking over M1. Now, on the back of this consolidation, we expect to see competition to come down. And we had analyzed markets all across the globe which had undergone this consolidation. And what we have found is that on consolidation or post consolidation, the industry growth improves by almost 4 to 5 percentage points. In market where the competition is super intense, like India in 2026-27, and when the consolidation happened in India, the improvement in revenues was even stronger. So before consolidation, revenue declines were double-digit level. Post consolidation in India, the revenue growth was double-digit levels. And Singapore to an extent is in a similar position right now. So on the back of this consolidation, we expect to see competition to improve, and to an extent, we are already seeing some early signs in the sense that Singtel has kind of pulled back its one of the challenger brand called Hea, and StarHub, they have a flanker brand called 8, and under 8, previously they were offering mobile plans at $8. Now they are pushing for $12 and $15. So we are seeing some early signs, and that's a positive move going into 2026.
Got it. Now, when we talk about policy reforms, I think the biggest policy reform we saw in Singapore this year was the MAS equity market reforms. And I think the initial thrust of that has helped the market. As I said earlier in the show, overall volumes have enhanced by about 50% this year. The number of delistings for the first time is at one of the lowest levels we have seen in since I think at least 2014. So, the market is moving in the right direction. And one of the key changes is this value up program that they're going to introduce. And we think that's going to be one of the bigger drivers for next year. We think the small and mid caps will be a key beneficiary of this. A lot of value to be unlocked there. A lot of the market in Singapore trading below one-time book, even with the recent rally. So there's a lot that can happen. Jarek likes names like CSE as well as Add Value Tech, which he calls the moonshot pick. Overall earnings increasing very, very rapidly, and I think it'll start to get a lot more attention from the institutional investors as well. But another sector which I think will benefit quite a lot are the Singapore REITs. We've seen them kind of coming in pretty early this year, capital recycling, trying to get their portfolios right. So let me bring Meow Meow at this stage. Meow Meow, how would you characterize the performance of the S-REITs this year, and what have actually been some of the key challenges?
Yeah, hi, Dylan. Yeah, so Alstri's sector performance has been pretty resilient, but lagged the broader market, with REITs index up around 10% year to date versus around 20% for STI. But earlier this year, the sector faced headwinds from geopolitical tensions and also uncertainties around US tariffs, which weighed on the business sentiments. And this translated into sector softer expansionary demand across both office and retail sector. Even for the best performing sector in 2024, wasn't immune. So hospitality earnings was dampened by a more cautious corporate travel budget, while potential tariff effects on pharmaceutical and semiconductor contributed to moderating rental reversion for logistic rates. That said, we observe an inflection point in second half 25, with most of the index capital gain occurring in October 25. And this was driven by a more accommodative interest rate environment and also increasingly muted market concerns around the tariff risks.
No, Meow Meow, we have seen a pretty decent capital recycling pickup for the sector this year. What do you think that's driving that, and how do you think that will shape up as we go into 26?
Yes, so capital recycling activity in 2025 were underpinned by a sharp decline in 3-month SORA, which declined by around 200 basis points year to date, and also 10-year Singapore government yield down by around 90 basis points year to date. While acquisition volumes have yet to return to pre-rate hike levels, easing funding cost and gradually improving market condition are expected to support the resumption of disciplined capital recycling in 2026. And EQDP should also further bolster the trend as participating fund manager increase their engagement in Singapore equities by placement or like a preferential offering exercise.
Okay, I'm going to come back to you on stock picks, but I want to bring Eric here. Now, Eric, we also saw the transport sector also having a refresh in terms of its policies. What are some of the key focus areas, and how do you think that's actually going to impact the land transport sector?
That's right. The new strategic blueprint will chart the next phase of Singapore land transport system, with consultation taking place over the coming year and targeted for release in 2027. This long-term master plan will reveal key priorities in light of the emerging needs such as the country aging population, as well as the changing travel patterns. It will also consider emerging technological developments and its impact on transport, such as AV and the use of AI in transport, such as smart traffic management and sustainability. So overall, we think that this is net beneficial for ComfortDelGro and is in line with the group long-term strategy to expand its AV offerings. In fact, in last month, the transport operator also signed a MOU with Hello Robotaxi to jointly deploy large-scale commercial robotaxi services in China as well as overseas market.
Okay. Now, Hussaini, let's come to internet, right? I mean, internet as well, you highlight in your, reflections that competition has been pretty rational this year, which is not the case normally with internet names. So what's going on there? What's the competitive dynamics that you're seeing? And how do you think that's going to affect Grab and Sea?
Yeah, sure. So yes, 2025 was a phenomenal year for the internet companies from the point of view of growth. So both Sea and Grab reported very strong growth. In fact, we had seen an acceleration in growth. Both the companies, in fact, revised upwards their guidance multiple number of times this year alone. And a part of the growth was also because, in my view, means the market remains underpenetrated, that leads to elevated growth. But a part of the growth was also because of very rational competition and to an extent consolidation. So in markets like Thailand, Foodpanda exited from the food delivery business. In Vietnam, Gojek exited the ride-hailing business. And in general as well, we are seeing in the e-commerce space that Lazada had been under retreat. So overall, because of the underpenetration as well as because of the very rational competition, we had seen a fair bit of an elevated growth. Sea is growing its e-commerce GMV by almost 25+% rate, whereas Grab is growing its GMV on mobility and food delivery at more than 20% rate. So net a very strong year. One other development which took place is that on and off news related to Grab and Goto merger. Very recently, there had been discussion that Danantara wants to be part of that merger. So let us see how it pans out going into 2026. But in general, 2025 was a very strong year from the operational point of view. Now, for Sea, maybe Southeast Asia, ASEAN was very strong, but we had seen some cracks in or some competition in other outside of ASEAN, which is Taiwan and Brazil. So in Taiwan, Coupang has been making, they are growing faster. They had been making elevated investments. And in Brazil, Mercado Libre as well as Amazon raised some competitive intensity. But so far, the growth for Shopee or Sea had remained quite elevated. Now, from the point of view of the stock selection, we prefer Grab, and we downgraded Sea to a non-consensus hold, I think in October this year. So for Grab, what we see is that the competition remains rational, and going into 2026, we see that there is room for margins improvement. But for Sea, why we downgraded it to hold is because company is kind of indicating that the margins improvement will be a bit softer going into 2026. So we are of the view that let's take a pause and see how the margin trajectory evolves. There are some competition concerns outside of ASEAN as well. So that's why we have downgraded to a hold.
Okay. I mean, in the interest of time, your two favorite stocks, Singtel and Grab for your sectors?
So Singtel, Grab, and Startup, we are buy on the name. See, Singtel has done exceptionally well this year, but still the holding company discount is at 28%, whereas pre-COVID it was 10 to 15%. There are so Singtel is a big group, right? So when we see that India is doing really great, and India is a very big part of the SOTP. Thailand is doing great. Indonesia, we are seeing the growth coming back for Telkomsel. Data center business, AI side, they are making big inroads. So there are much more catalysts to keep an eye on. But from the delta point of view, I would say that maybe between Singtel and startup could offer a better, bigger delta going into 2026, mainly because of the consolidation in Singapore, and startup has a bigger exposure compared to Singtel because Singtel is much bigger. Grab as well, as we said, that we look forward to a strong growth to continue in 2026. So my pecking order between these three names will be startup, Grab, and Singtel.
Got it. And Mia, two favorite stocks very quickly.
Hi, Dylan. Yeah, so our top pick remain to be CICT, CapitaLand Integrated Commercial Trust. Yeah, so it's preferred as a significantly high occupancy and positive rent reversion. So despite a lower yield, it's very strong credit rating, and the Singapore concentrated portfolio makes it our one of the top buy. And for the next one, probably we favor CapitaLand extender rate. It stands out for its very active capital recycling, refinancing progression, and now stronger than expected rent reversion, supported by a very robust balance sheet and a large diversified portfolio.
Got it. And then finally, Eric, two favorite stocks?
Okay, for healthcare, we prefer Raffles Medical in view of its earnings defensiveness, as well as which comes as an option on its China turnaround, following certain cost measures which were put in place earlier. Management has previously guided for its China operation to achieve EBITDA break-even by the end of 2026, and backed with the group's strong balance sheet and net cash position, Raffles has also pledged to buy up to 100 million shares over the next 2 years, as well as pay out 50% of its core earnings to shareholders. And we also like Comfort Delgro. I think we mentioned earlier that the group has a long-term strategy to expand its AV offerings in line with the policy refresh on land transport. And we have a target price of $1.70 for Comfort Delgro.
Great. And for financials, we like OCBC, given the AI uplift, as well as potential capital returns going into next year, as well as SGX, given all the volume increases that we are seeing. Now, very quickly going into AOT, I just want to remind, this is a SDR stock on SGX. We view AOT positively following the board's approval of a duty-free contract scheme at SUNPOWER Airport, which introduces a minimum guarantee. The Civil Aviation Authority has also raised the international passenger service charge much higher than what we expected as well. Given these developments, it's giving us room to upgrade our target price. And with that, we rate the stock as a buy. We're also downgrading Bukalapak to hold, despite actually raising the target price a little bit. The story has shifted from growth to capital discipline, and we are not really seeing much of a compelling catalyst on the stock. And we are also a bit worried that this stock can be a cash trap. They sit on about 24.6 trillion rupiah of cash. But they have very limited avenues for value accretive deployment. So do have a look at that. Despite low valuations, it can remain low for a while. Our chart guy has a couple of brand new ideas. He's got a trading buy on SUNPOWER Group and a trading sell on AEM. With that, We are out of time. On behalf of my team as well as Maybank Securities, I want to thank you very much for your support throughout 2025. It has been a very volatile and action-packed year, so hopefully our insights have helped you throughout your investing journey this year. And we will be taking a short break from the show from today, and we'll be back on the 5th of January. Our daily newsletter will still be out every day. Until then, we wish you a joyful holiday season and a happy new year. And thank you so much again for your support. See you in 2026.